Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Today's guest is Liz Ann Sonders. Liz Ann is the longtime Chief Investment Strategist at Charles Schwab. She's responsible for market and economic analysis and investor education for the firm's 34 million accounts and probably rising by the day. Liz Ann has been at Schwab for over 25 years and is a regular guest on CNBC, Bloomberg, CNN, CBS News, and other business news networks. Welcome, Liz Ann.
Oh, thanks for having me, Alex. Much appreciated.
And just to timestamp this, we're recording this podcast on June 10th, 2025. Liz Ann, the first principles of investing are often considered to be: 1, maintain a long-term discipline; 2, be diversified; and 3, avoid all the behavioral missteps. These are simple in theory, but challenging in practice, as you know. But what are your thoughts on why this is so difficult for most investors?
Because it's our money and we have emotional attachment to our money. And it tends to, I think, exacerbate those natural emotions of fear and greed, which tend to infiltrate investment decision making. And, ideally, what investors can do is not figure out the hard way whether there's a wide or narrow gap between what we could think of as financial risk tolerance, what's on paper. We sit down with an advisor, we map out a long-term strategy. It involves your financial risk tolerance. But then there's the emotional risk tolerance. And unfortunately, a lot of investors learn the hard way that there's a pretty yawning gap between those two. And it is those classic emotions of fear and greed. And it's why those tried and true disciplines, you mentioned diversification, such a key one, and then periodic rebalancing, which forces us to go against those emotions. It forces us to essentially do a version of buy low, sell high. It's add low, trim high. Of course, often when left to our own devices, we do the opposite, and that's where those emotions of fear and greed tend to come in.
It's so interesting because when you describe it that way, buy low, sell high, everybody would agree that's a good investment strategy. Yet our emotions force us to do the opposite of we buy high and we sell low. We buy the things that have done well and we want to sell the things that have done poorly. Why do you think that is, even though it's illogical and obviously illogical?
And I don't even know so much that it's that we continue to buy. Yes, there is a lot of that momentum chasing, lots of acronyms, including, FOMO. But I think it's just as importantly the decision not to trim back, the emotion of why wouldn't I just let my winners run, and putting maybe in the back of your mind the potential peril of having overly concentrated positions and not letting that rebalancing work in your favor. I think it's just human nature. And I always say to investors, it's not what we know that matters, meaning about the future, what the market's going to do, what a particular stock is going to do, picking tops and bottoms. That's inherently unknowable. It's what we do along the way that matters, not what we know, meaning about the future. So I think sometimes we just have to think in real world terms about how emotions play trick with us. I have such a great story, and it's a short one. I was out in the Silicon Valley area less than a year ago, and I was having a conversation with a client who had a very concentrated position, maybe no surprise, in NVIDIA. And he was very lovely, wasn't angry, but said, "I'm a little frustrated. My Schwab financial consultant kept trying to tell me that I should maybe pare back about 10% of my position. They were going to do it in a tax-friendly way. I fought back on it. I ended up trimming 5% of the position, and then the stock quickly went up 20%. So I'm kind of mad." And I thought, and I said to him, would you have been happier if the 95% you still owned went down 20%? And to his credit, he paused. He said, "I guess that's the way I should think about it." So that's just an example of how those emotions tend to play tricks with us.
It is very interesting in that there's also this aspect of investing where hindsight, we've heard hindsight is 2020, but it's interesting how people look back and they say, "I knew that was going to happen." And then they conveniently forget the things that they thought were going to happen that didn't. And so you get this selective memory and you become overconfident in your ability to predict. And that kind of feeds into all of this as well.
Correct.
So I talked about the kind of the three core principles: long-term investing, diversify, and avoid the behavioral missteps. Are there any other core principles you believe investors should embrace?
Well, I think I phrase it in terms of one of the mistakes that investors make, and it has to do with the connectivity between time horizon and risk tolerance. And I think too often investors think that there's a direct link between your time horizon and your risk tolerance. Meaning, if you're young, you're automatically a risk tolerant investor and you should take a more aggressive stance, vice versa if you're on the older end of the spectrum. But actual tolerance for risk is more than just about time horizon. You can be a 30-year-old investor and still have a long time horizon before, say, retirement. But if at the first 10 or 15% drop in your portfolio, that fear factor is going to kick in and you panic and sell, I don't care how long your time horizon is, you are not a risk tolerant investor. I had the great pleasure many, many years ago, somewhat obviously, of meeting the late, great Sir John Templeton. And he was in his early 90s when I met him, and he talked about still being a fairly aggressive investor at that age. It obviously was not because he had a long time horizon ahead of him, but he understood the risks and he was willing to take risk. He was also a billionaire, so maybe that's a factor too. So I think that's another area we need to focus on, is those real tenets of risk tolerance and the questions you need to ask yourself. And those questions need to go beyond just how many years do I have between now and retirement.
Yeah, I guess that's one factor. But what the factor that really matters is what your actual time horizon is for the investment that you're making. And if you're prone to selling when you get a downturn, and people always forget the downturns associated with really bad news and a bad outlook. So if you're prone to that, then your time horizon is much shorter than what the math would suggest. And that's what you have to be honest with yourself about. And you have to kind of look back and ask yourself, how did I react the last time something bad happened? And have an honest assessment of what your actual time horizon is.
Absolutely. And I think also understanding the connectivity between what's going on in the real world, in the economy, and what's going on in the market, and understanding that there is a connection there, but the timing is often off. And also understanding that, and I've been saying this for my nearly 40 years in this business, we as humans tend to think in absolute terms. Was it good or was it bad? Was it strong or was it weak? Now I'm talking specifically about a piece of economic data. When, as it relates to how markets behave, more often than not, better or worse matters more than good or bad. Yet it's human nature for us to think in good or bad terms, but it's that rate of change, it's that direction of travel that often matters even more than the level of whatever it is the data is showing.
There's one other aspect, and it's related to a little bit to what we talked about earlier, which is everywhere outside of the investment world, past returns are indicative of future results. If you have an underperforming employee, they'll probably be underperforming in the future. If you have something that's working in the past, it'll probably work in the future. Investing, oftentimes it's the opposite. The better something did in the past, it's basically borrowing future returns today, and it may underperform in the future. And so it's easy to be sucked into chasing returns in the world of investing because that discipline is reinforced everywhere outside of investing.
But going against that grain is very difficult from an emotional perspective, and that is what can trip investors up. But that's a very good point.
Let's move into kind of the outlook and news. Many investors focus on short-term news and are vulnerable to major economic shifts, some of these major inflection points. Do you believe we are at a significant economic inflection point today?
I think we definitely were in the beginning of April. Had those reciprocal tariffs that were announced on April 2nd gone into effect, and we don't know ultimately what happens at the end of what was the subsequent 90-day delay that was announced, I think it was a massive inflection point in the economy, because we were talking about at that time an average effective tariff rate of somewhere in the mid to high 20% range, up from less than 3% pre-inauguration day. That would have represented an epic change, well beyond even what we saw during the Smoot-Hawley days of the Great Depression. That said, where we are right now is a 15% average effective tariff rate, 5 times bigger than where we were before. So I think that there is a little bit of complacency, maybe because of what I actually said before, which is better or worse matters more than good or bad, and things are better. But I do still think that we are at a potential inflection point here. And some of it is just the natural inflection point of going through cycles, and recessions haven't been outlawed. We will get one again. But I still think we could be at a trade war related inflection point, not to mention something even more existential, bigger picture, if there's a continuation of trying to truly reorder the world from a global trade perspective, which, we have an incredibly complicated global ecosystem of trade, and trying to unwind that in short order, I think brings with it some volatility that in many cases we've already seen, but I think could still very much be ahead of us.
Let's stay zoomed out for a little bit. So until recently, we've enjoyed low and stable inflation for decades. Do you expect inflation volatility to rise in the coming years?
Yes, and I'm glad you asked the question that way, Alex, because if you had said, do you expect high and sustainable inflation on a forward-looking basis, my answer would have been no, but inflation volatility. So the period from the mid-1990s up until the early part of the pandemic, often referred to as the Great Moderation era, to your point, was characterized by limited inflation volatility, as a result, less monetary policy volatility, less overall economic volatility. We also had the massive wave in that era of globalization that really kicked into high gear in 2001 when China joined the World Trade Organization. We also had the energy boom in the United States, courtesy of fracking and shale, moving the United States to be energy independent. All of those forces conspired to provide that backdrop of a fairly benign inflation environment, somewhat benign monetary policy environment, leaving aside, obviously, the global financial crisis. And I think most of those ships, quite frankly, have sailed. And I think the environment we're arguably already in, if not in the process of transitioning into, may look a bit more like the period from the mid-60s to the mid-90s, where you had more inflation volatility. Again, that's not the same thing as saying high inflation for an extended period of time, but we certainly saw in the 1970s a tremendous amount of inflation volatility. I don't think that's what we're facing, because that was in large part due to monetary policy mistakes of hanging the victory banner, easing policy, only to see inflation let out of the bag again, then having to scramble and tighten policy. That happened 3 times in the 70s, ultimately leading to Paul Volcker having to come in and pull a Paul Volcker and ramp up interest rates, bring on back-to-back recessions in order to really finally break the back of inflation. But I think with this deglobalization or regionalization or just in case versus just in time, whatever terminology you want to use, not to mention geopolitics and demographics, I think means we're probably in a more volatile inflation backdrop, which again leads to potentially more volatility in monetary policy, maybe even fiscal policy, probably shorter economic cycles. The good news about the period from the mid-60s to the mid-90s is that the up parts of the cycle from an economic growth perspective were actually stronger than during the Great Moderation. So it isn't all doom and gloom with that comparison.
And are there any other specific investment implications if we do experience inflation volatility?
Yeah, potentially important ones. So for almost the entire, call it 25-year period of the Great Moderation, bond yields and stock prices moved in the same direction. And that's because we had a benign inflation backdrop. So for instance, in that era when bond yields were going up, it was typically reflective of growth improving without the attendant concern about a big inflation problem. Stronger growth without an inflation problem is sort of nirvana for equities, and vice versa. When yields were coming down, it was reflecting weakening growth, potential recession, negative for the equity market. Well, rewind back to that 30-year period from the mid-60s to the mid-90s, nearly that entire period, the relationship between bond yields and stock prices was the opposite. In that era, because inflation was sort of the bugger, when yields were going up, it was often reflecting one of those sort of up cycles in that volatile period of inflation, not necessarily attendant stronger growth, much more negative for the equity market and vice versa. Recently, we've been kind of bouncing in and out of positive and negative correlation territory. And I think the near-term reasons why you tend to bounce around is if inflation is keying, I mean, if yields are keying off inflation, you tend to see that negative relationship, higher yields, lower stock prices. If inflation settles down, there's less inflation volatility and yields become a little more connected to the growth outlook, higher yields, higher stocks reflecting the growth outlook. So I think understanding that relationship in the short term requires the why behind what bond yields are doing. So I don't think the period that we're in is going to look exactly like the mid 60s to the mid 90s, lots of other differences, but maybe that more volatile inflation backdrop could be a cornerstone of the next secular era.
And that also feeds into how one should think about diversification. Because for that great moderation period, 90s until recently, stocks and bonds were good diversifiers for the reasons that you described, because inflation was relatively low and stable and growth was moving around, and those are good diversifiers in different growth environments. But if you have both growth and inflation volatile and uncertain and unpredictable, then you probably have to think about diversification beyond just traditional stocks and bonds.
Yes and no. You're right. In that very simple relationship between bond yields and stock prices does change the calculus around diversification. But what it may suggest, maybe even more so on the fixed income side of things than on the equity side of things, is a more targeted approach, maybe a little bit more of an active approach, and or just holding fixed income securities to maturity so that you're not as subject to the price swings, and you're basically banking on earning the yield over time. So there are strategies that can be employed, not to mention the fact that the availability of asset classes other than simple stock exposure, simple bond exposure, even for smaller individual investors, is such that the diversification story can span beyond just your generic 60-40. And that allows for the ability to find diversifiers that move outside of that very simplistic asset allocation structure.
One of the terms that's probably overused today is uncertainty. There is always some level of uncertainty in markets, but do you think that the risk of extreme outcomes is higher today than usual?
Yeah, so you and I were chatting before the cameras went on, and I think you're right. I always chuckle in my own mind when I hear the market hates uncertainty. I don't know. Have you ever woken up to a Wall Street Journal article that said there's nothing, everything is certain right now. We know everything. There's always uncertainty. I think maybe the better descriptor for the current environment is unstable, which has just a slightly different meaning. And when we think, therefore, about tail risks, yeah, I think the tails are a bit wider than they have been in the past. Unfortunately, I think that left tail risk, which is the potential negative outcome, might be a little more fat, as they call it, than the right tail risk. I think we're living sort of in a right tail risk of that things in relative terms as opposed to absolute terms. You go from reciprocal tariffs on every single country and an average effective tariff rate of close to 30% and Armageddon scene in global economies to, okay, not as bad as we thought it was going to be. But I think we can't dismiss, notwithstanding how strong the market has been, and maybe an example yet again of the market likes to climb a wall of worry, but I do worry that there is some complacency that might have kicked in with regard to economic outcomes, inflation outcomes, the reaction function on the part of central banks, this unique period of certainly during the early April carnage of seeing the equity market down at the same time bond prices were down because yields were going up and the dollar down. That is somewhat unprecedented activity across those three asset classes in the United States. Not atypical to see that in emerging markets. It is in the United States. And that combination, I think, was the trigger to get the administration to de-escalate. So I do think market forces might continue to be that message on, okay, we need to pull back a little bit here. That said, I'm not going to try to get in the mind of the policymakers here. It's mercurial to say the least.
Well, trade wars and tariffs have so far had limited inflationary effects. You just touched on that. Was the initial concern overstated, or are we still early?
I think we're probably still early. If you look at the latest CPI and PPI data, so consumer price index and producer price index, and we get the next reading on those, I think it's this week. But the prior reading that we have in the books, the reference period that covered encapsulated an average effective tariff rate of less than 5% versus the 3% where we were pre the initiation of the trade war. So we don't have a lot of the data actually in the numbers yet. Now it will start to be reflected in the data. That said, inflation measures cover more than just the prices of goods that are being impacted by tariffs. And that's going to be the interesting, I think, necessity of looking at inflation data, is having that fine-tooth comb. So when we get it, for instance, the CPI data, there's a very heavy component of CPI that is what we call broadly the shelter components, inclusive of owner's equivalent rent. There's actually pretty significant downward pressure in those categories versus likely upward pressure on goods-oriented categories that are directly impacted by tariffs. So I think we're going to have to do a lot of parsing when we get this data to truly see the impact, not to mention that it's probably going to take some time for it to really filter through. We are hearing from most companies that they're going to try to pass on a decent amount of these costs. And by the way, I've gotten into a habit, Alex, of just throwing out the actual definition of tariffs. And the reason why I've been doing it is I've been surprised at how many times when I do it, people come up to me afterwards and say, I didn't quite know that that's how tariffs work. So notwithstanding the headlines of tariffs on China, tariffs on Canada, or even as recently as yesterday or today, I heard President Trump saying, we should have been charging China all along what we're charging them now, and they're now paying us more in tariffs. Well, that's not how tariffs work. Tariffs are paid by the US company importing the goods from China or the European Union or Canada or Mexico, whoever the targeted country is. So it's a tax on US companies. A valid debate is who ultimately bears the cost at the end of the proverbial day. One thing that does not happen is the targeted country doesn't tend to cut their costs in order to offset the tariff that the US company pays. So then it's a question of US company pays it. Do they eat it in their profit margins? Do they try to pass it on to the consumer? The latter is what tends to happen. But we're just at the stage of companies trying to navigate that, figuring out what can stick. We know they built up inventories by front running the tariffs, and they built up inventories at a fairly low cost basis. So there is a lot of experimentation right now. You're even hearing from some companies saying, we plan to raise prices not just on goods that have tariffs attached to them, but in general in order to protect our profit margins. So there's going to be a lot of data that we're going to have to parse through in the next few months to get an accurate sense of this. But I think it's too soon to just look at the recent inflation data and say nothing to see here. It was all overblown. I think there's still a lot more impact still ahead of us.
That's helpful perspective. Thank you. So obviously we live in a world of heightened economic policy and geopolitical, I won't say uncertainty, but instability. How should investors think about portfolio construction given that backdrop?
Carefully. But I think this is really where discipline comes into play. It is hard enough in any market environment to try to time things. So the all or nothing, get in, get out strategy, we would never recommend, even in the most certain of times, as if there is such a thing. But in particular, given as we've seen over the past few months, that knee-jerk extreme moves we can see in the market off of literally a social media post tells you that you want to step back. If anything, you want to reinforce a longer term time horizon, not think in shorter time horizons, reinforce those disciplines of not just diversification in general, but across asset classes and within asset classes, having that periodic rebalancing approach. Frankly, it's the stuff that, if I go on CNBC, if you bring on a guest on your podcast, it's the more boring stuff to talk about. If CNBC is having one of their markets in turmoil 7 p.m. specials, they're unlikely to want to hear me talk about the beautiful disciplines of diversification across and within asset classes and rebalancing. They're going to typically ask somebody like me, okay, Lizanne, are you telling your investors to get in or get out? Well, those are just gambling on two moments in time, and that doesn't tend to work out. So I think, if anything, this type of chaotic backdrop should really reinforce those long-term disciplines. I wish it was more bombastic or fine-tuned, or it's just that's the way you need to approach it. More specifically, stay up in quality. Understand that now it looks like international diversification is paying some dividends. That was a harder sell. So take advantage of some of the market, some of the voices coming out of the market in terms of reinforcing some of those disciplines around be careful about not allowing positions to get concentrated, and be mindful that the benefits of diversification can sometimes show up really quickly.
And the other point that I would add, and I'm curious if you agree, to maintaining that long-term discipline and being diversified and all those things, is that when you have more news around the uncertainty and the instability, you're also more likely to react, and your emotions may be, bubbling at the surface and could cause you to, have those behavioral missteps.
Absolutely. And, more often than not, as the news on the economic front, on the geopolitical front, whatever it is, the non-market specific news, as it becomes more heightened, you tend to see volatility and weakness in the market, but it also ends up with the benefit of hindsight, you get that aha, it ended up being an interesting opportunity that was represented an inflection point of sorts for the market. Not necessarily a message to try to time that, but understanding that when it comes to even something as specific as there's a number of different policy uncertainty indexes out there. Bloomberg has several that they track. They're sometimes global in nature or domestic in nature. It might be specific to just trade policy or more broadly economic policy uncertainty. And interestingly, market performance following extremes in those types of uncertainty indexes have actually been pretty strong, because the market prices a lot of that uncertainty and that risk in, and therefore provides an opportunity. So if you're purely reacting emotionally, especially if your attitude is, I'm just going to get out until things calm down, until the skies are clear again, you've probably missed some of that inflection point that naturally comes at times where it feels most uncomfortable.
How do you evaluate major stock market cycles? And where do you think we are in the current cycle, particularly in the US?
Well, there's lots of ways to think about market cycles, but I must say here I'm going to invoke Sir John Templeton again with probably the most famous thing he ever said about markets, which is bull markets are born on pessimism, they grow on skepticism, mature on optimism, and die on euphoria. And I think that's such a brilliant way to think about a full market cycle, in part because it's exclusive of anything related to what we think of as driving markets. There's nothing in that line, so to speak, about valuations or sentiment. Well, it's everything about sentiment conditions, but economic conditions, retail sales, or what the Fed is doing with the Fed funds rate, or QE, or GDP estimates. It's just about emotion. So I absolutely think about market cycles in the context of investor sentiment at extremes. I think that there are cyclical cycles and secular cycles. So cyclical cycles can happen in an ongoing. I like to try to get a sense of whether if we're in a strong market environment like we have been in the last month or two, is it likely in the context of being in an ongoing secular bull market, or might it just be a rally in a bear market type cycle? So thinking in those long cycles. Valuation does to some degree come into play, but more on those long-term analysis of cycles, because we've done a lot of work on valuations, whether it's your traditional PE ratio or price to book or any number of valuation metrics. If you look at valuation at any point in time and subsequent 1-year return for the equity market, there's no correlation. Stocks can be really expensive and still do well over, say, a 1-year period, vice versa. If you lengthen that out to 10 plus years, you have a greater connectivity between valuations and subsequent returns. Overall exposure that households have, positioning, the fact that recently the so-called Buffett model, the total capitalization of the entire US stock market as a share of GDP, hit an all-time high. Households' exposure to equities is at all-time high. Those two things should sort of temper your expectations for equity returns. It doesn't mean negative, but you have to be careful about extrapolating periods where you've had outsized longer term returns into the future. So you've got that sentiment component, both long term and short term, the valuation component, short term and long term, and then these more exogenous things like we're dealing with right now. Are we truly in something existential with trying to change how the global world order works? And that's a whole different chapter in this story.
And if you think about that backdrop, you would think this is an environment, if you ask the average investor, do you want to be more diversified or less diversified, given the instability that we're facing? And I would guess most people would say, I want to be more diversified. But if you look at their portfolios, most people are probably less diversified than they were 10 years ago.
Correct. And I think if you look at what has become a very, very powerful force within the market, which is the retail trader. Notice I emphasize retail trader. I'm not talking in general about individual investors, but that retail trader that grew out of the pandemic that now represents a higher share of day-to-day trading volume than high-frequency traders, than quant-based or algo-based hedge funds. They're a really powerful force. I'm not sure that cohort would answer the question with, yes, we should be more diversified. I had I'll give you another anecdote of an interesting conversation. And, by retail traders, they tend obviously to skew a little bit younger. I was on a plane about a month or two ago, sitting next to a young gentleman who was looking over his shoulder at my iPad app and saw that I was reading lots of research and I had lots of charts. And he said, do you mind if I ask what you do for a living and what you're reading? And I told him. So we had a conversation and he said, well, my family just had a liquidity event. They sold a portable toilet business for a lot of money, and he's 23 years old, and his 21-year-old brother. He said, we're just new to investing. We're taking a really, really conservative approach. So we have 75% of our money in the SPY, the S&P index, and only 25% in the NASDAQ 100. And he said that as if that was an incredibly conservative approach. And I said, keep in mind, that's 100% of your assets in large cap growth stocks, essentially. And so it's a mindset that's there and hasn't been tested yet. But I think we also have to think about the sentiment backdrop as different depending on what cohort you're talking about. I think the older, more seasoned individual investor would absolutely say it's more important to be diversified right now. I'm not sure every individual investor or trader out there would say that.
That's fair. Now, you touched on this a little bit, but many investors use the US stock market as their benchmark for portfolio's performance. But how do you balance that reference point with maintaining proper diversification, especially as US stocks have become increasingly concentrated even within that component?
Yeah, Alex, I find it funny if you really probe with people who say that their benchmark is the S&P 500, that in reality, that's the benchmark on the upside when that index is doing well, and amazing how quickly the benchmark becomes a positive cash return when that index or the market in general is doing poorly. So there again is the psychology and the emotional side of things. But you're right. The S&P 500 is not only basically a large cap growth index, it's become increasingly concentrated, with the 10 largest names recently hitting 40% of the index. And in fact, traditional mutual funds and many exchange traded funds that are either sector based or index based actually have limitations on how much exposure they can have to either individual stocks or even at the sector level. So there are times where even some of these products that are so-called indexed, you're not quite getting the same exposure. That might be to your benefit, given that an actual true index approach to the S&P as it's constructed means you are taking a very concentrated approach. And in order to avoid that, that means either, taking more of an equal weight approach versus a cap weighted approach, kicking in that rebalancing maybe a little bit more frequently, understanding the merits of having diversification internationally. This is a year that really reinforced that message with, at least as of a couple of days ago, the MSCI EFA index outperforming the S&P 500 by 14 percentage points on a year-to-date basis. That's just a year-to-date basis. We're not even halfway through the year. So we do get healthy reminders like we have this year of some of the perils of that concentration risk. And that would apply to areas like the Magnificent Seven or, the smaller AI cohort, whatever mini cohorts of darlings that you want to talk about.
Let me ask you a couple of questions about fiscal and monetary policy. So how might the Fed navigate its dual mandate in the face of what, at least so far, appears to be persistent inflation?
So I think that as the Fed thinks about their dual mandate, the decision around assuming they will take themselves out of the timeout they put themselves in last year and move to easing policy again, I think it will be the labor market side of their mandate that triggers that more so than the inflation side. What I mean by that is, I think if we were to start to really see some cracks in the labor market beyond just some small ones, we've already seen that even if inflation hasn't come down to their 2% target, they will move and ease policy to support the labor market. Worst case scenario would be some massive spike in inflation and accompanied by weaker employment. Then that's that egregious stagflation kind of backdrop, which means their dual mandate is working at complete odds. That's not our base case by any means, but part of our job is to think about what the risks are. But I think their eye that's on the labor market side of their mandate may be a little more open than the eye that's on the inflation side of their mandate. And again, we've seen some cracks. I think the most recent jobs report on the surface seemed good, but I think that there was some weakness under the surface, including the fact that there were big downward revisions, that there's now question as to how accurate these numbers are, given some of the cuts that have happened literally within the Bureau of Labor Statistics. The fact that the household survey, which is what the unemployment rate comes from, was very, very weak. That tends to lead at inflection points. So I think we want to keep a close eye on the labor market because I think it feeds into the consumption side of the economy for somewhat obvious reasons. And I think it's the direct feed into what the Fed does from here.
And on the fiscal side, what are your views on the massive budget deficit and then the recent U.S. credit rating downgrade?
So the credit rating downgrade was not that it was a non-event, but it didn't quite have the ripples that the initial downgrade by the S&P. That was all the way back in 2011. And part of the reason why that caused so much volatility in the market and a near bear market in stocks was at that time, many institutions, inclusive of pension funds, many endowments and foundations, had within their bylaws a mandate that they only own AAA rated securities. So that really caused an elevated amount of concern about what might have perceived as the necessity of a lot of these institutions having to sell treasuries in short order. All that was actually done, though, was just the language was changed to be investment grade. So when you had the Fitch downgrade in 2023, didn't quite have the same impact, same degree with Moody's. That said, I think it's one of many things this year that arguably has turned the wattage up on the spotlight that's on the deficit and debt. Another set of things that happened we already touched on, which is that unique period in early April where stocks were getting crushed, bond yields were surging, and the dollar was coming down. That was because of concern about debt sustainability and would there be ongoing demand for our treasuries. That ties back to tariffs. Tariffs, at least those reciprocal tariffs, actually weren't reciprocal to other tariff rates. They were reciprocal to our trade deficit with other countries. For all the negatives that are out there about why a trade deficit is bad, I don't happen to think that it's all bad. I think there's a lot of good about having a trade deficit, in part because the reciprocal of that, the mirror image of that, is you run a capital account surplus. So you import more than you export. That means dollars go out into the world. Those dollars have to be invested. They tend to be invested in dollar-denominated securities like treasuries, like our corporate bonds, like our equities. That helps fund our deficit. Now we're concerned about, is foreign demand starting to wane? If the goal is to eliminate trade deficits, do you then in turn mean you have less demand for dollar-denominated securities and it feeds on itself? So lots of different things that I think have elevated the focus on the deficit. Now, we've seen pretty ugly assumptions of where the deficit is headed over the 10-year budget window, inclusive of the One Big Beautiful Bill Act, which actually is the name of the bill, which is kind of funny. There was some CBO data that came out last week saying the tariff revenue is going to offset a lot of the massive cost associated with that bill. And that's fine. That is the math as of now. But what's interesting about that $2.8 trillion of estimated tariff revenue over the next 10 years is it assumes the tariff rate that was in place up to May 13th, that particular day, is going to carry for the next 10 years. I don't think you can have a 10-minute window with tariff policy, let alone a 10-year window. So I think given that, we're on an unsustainable path. It's just a question of whether yields have to really go significantly higher to entice people to go out the maturity spectrum. So far, it has not been extreme, but that's the concern out there. And it's driven by the unsustainability of the deficit and in turn, the cumulative effect of running deficits, which is our federal debt.
Lizanne, I appreciate you sharing all your insights and taking the time to explain all of that in simple terms that anybody can follow. So thank you so much.
My pleasure. I enjoyed our conversation.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.